In this chapter, we're discussing about pension funds. So a pension plan is a retirement plan. Okay. So what the employer will do is, actually we discussed this in an earlier chapter about pension fund, EPF, PPF. Okay. So pension plan is a plan where the employer or the company, your employer. So if you join a bank, your bank becomes the employer. They'll be making contributions. Okay. So you will make some contribution out of your salary every month. Some amount will be deducted and put in a pension fund. Similarly, the employer will also contribute some amount, that matching contribution. Together, that will be goes to a pension fund, so that you can, at time of retirement, you can use it for future benefit. Okay. So this pool of funds, what they do with that amount? It's not that the funds are idle. Okay. So money was deducted from your salary. The employer has contributed a matching contribution. So let us say your salary is 30,000. Say 3,000 was cut from your salary, and only 27,000 was given to you. That 3,000, what the company is going to do? The company will also make a matching contribution of 3,000. So put together 6,000. It invests in the provident fund. So there is a separate fund at the national level that all the funds will be pooled up. So that funds will not lie idle. Okay. So they will be invested somewhere. Okay. This is invested on the employer's behalf. So because whatever earnings they get, you will benefit from it instead of lying idle. If they get some interest and some benefit, it will be passed on to you. Okay. So it's good for you. So, in addition to the employee's contribution, some pension plans have a voluntary investment component. Okay, so pension plan will allow a worker to contribute part of his income into an investment plan. So, there are two main types of pension plans. One is defined benefit plan, and another is defined contribution plan. So, in defined benefit plan, the employer guarantees that the employee receives a definite amount of benefit upon retirement. This is regardless of how the underlying investment pool is performing. Okay, so what it means, the employer is liable for a specific flow of pension payments to the retiree, and if the assets in the pension plan are not sufficient to pay the benefits, company is liable to pay the remainder of the payment. Got it? Defined benefit plan means the employer will promise at the time of retirement you will get so and so amount, say 20 lakhs or 30 lakhs. That's the defined benefit. But we discussed earlier that the amount which they're cutting every month, they will be invested somewhere. It might so happen that where you're investing, it's not getting good return, and really you're not eligible to get that 20 lakhs or 30 lakhs, but still irrespective of that you will be paid whatever there was, because this is a defined benefit plan. On the contrary, there is another pension plan called defined contribution plan. Here employer will make specific contributions for the worker. Usually it's a matching contribution, so if you make 3,000, it will be 3,000. So the final benefit will be dependent on the plan's performance, investment performance. So the company's liability ends when it makes the contribution. So how the investment does and what return is obtained is immaterial to the company, and this is much less expensive than the traditional pension. So these days you see a large number of companies are moving towards this type of plan. Okay, so defined benefit plans are almost ended now. So let us see what is this pension fund. So when a defined benefit plan is made up of pool contribution of employees, it's commonly referred to as pension fund. Okay, so this is run by a financial intermediary managed by a professional fund managers on behalf of the company, hence employees. Okay, and these are very large funds. Okay, they can dominate the stock markets in which they're invested. They represent one of the largest institutional investors in many countries. Okay, so the advantages of pension fund is it provides a fixed preset benefit for employees upon retirement, and the employer makes the most contribution, cannot retroactively decrease pension fund benefits. And since benefits do not depend on the asset returns, benefits remain stable. Okay, in a changing economic climate like increasing inflation and all, your benefit will be stable. So in this chapter, the questions to be prepared are: what is pension plan, what is defined benefit plan, what is defined contribution plan, what is a pension fund, and what are the advantages of pension fund.